There's a bubble in the self-storage market. It's gonna pop. This could mean bankruptcies, this could mean defaults, or this could simply just mean a lack of performance for a given period of time. What's up, guys? We all remember when housing got into a bubble, and the bubble is right before everything readjusts, right before it pops. So a bubble is caused by increasing prices and expectations that those assets will probably never be able to deliver. Then the market has to readjust expectations. We have to restructure our expectations financially. Right now, what we're seeing in self-storage has led us to not only believe there is a bubble, but we also believe that that bubble is about to pop. Self-storage has been on an absolute tear after 2008. A lot of assets in 2008 were at the end of a long development cycle where prices have gone up, supply had hit the market, and in 2008 there was way too much debt and those assets crumbled. Self-storage had one of the lowest default rates of any assets and the lowest in commercial real estate. And banks didn't like financing storage facilities, so you couldn't put a lot of debt on them. Valuations and where we bought storage facilities were very high. That meant we had big margins and lots of cash flow. That all made it so self-storage could survive the Great Recession in the way that it did. This created a narrative within self-storage. There was this idea that it is very recession resistant, and it did so well, we should move into this asset. Since 2008, money has just piled into this industry in the form of development and also institutional buyers. Banks now wanted to lend on self-storage. Third-party management allowed funds and Wall Street to really get in the game. This made a rush for demand, and it started to drive cap rates down and prices up. Remember, cap rates in the simplest form, a high cap rate means you expect to get a higher return. The lower the cap rate, the lower the return expectation is. It's self-reinforcing. As demand from investors surged, so did it from consumers. The Great Recession had left a hole of no development, and that had caused increased demand for the product. That means people rushed in to buy because they knew rates would go up because of limited supply. That also meant the developers came in and they started developing at mass. We got into our development cycle, which today we're at the end of the development cycle. At the end of a development cycle, when you oversupply the market, prices come down. As supply grows, that's more opportunities for customers, and storage facilities compete on price, therefore driving down the price that customers and tenants had to pay. So at the end of a development cycle, when all new supply has come on, rates start to turn. That started to happen right at 2019. For the first time in a long time, we start to see increases in vacancy rates. Occupancy was dropping, and we saw rental rates dropping. That's healthy. That's what we want to see. That's good. Now we hit the catalyst. So, where does self-storage demand actually come from? It's important to remember that people moving around and reallocating is a big reason that we utilize storage. In fact, 44% of the tenants say that moving is the reason why they're utilizing self-storage. As you can see here, as houses sell, that drives up demand, which then as more houses sell, they build more self-storage. It's directly correlated. After the development cycle, in 2019, we started to see vacancies rise, rents start to drop. The market was correcting for the oversupply. But then COVID happened, and that changed everything. This had a very interesting effect on the market, but for self-storage, it fueled demand. It fueled demand from customers and businesses that could no longer get together and work. They started to do more out of their storage facility. They started to move because interest rates dropped. Demand went up, occupancy went up. But this is very special. I call this the COVID bump, meaning it's an artificial push from a time in which the government is having mass intervention and these assets are a huge beneficiary. Most importantly, it stopped the overall rise in vacancy and the deceleration of rental rates in many, many markets. The COVID bump was fueled by lower interest rates, the lack of people being able to go to work, and other things. So how does the bubble pop? As of now, we will begin to take off the Band-Aid that covered COVID. This is a readjustment for capital markets, for individuals, homeowners. This is where we see the risk. Due to this restructuring, inflation rising, which in return is causing a rise in overall interest rates. Interest rates have a very interesting effect on self-storage. The first thing it does is it changes cap rates or valuation. Higher interest rates mean valuations go lower. What happens when you bought a deal that was really expensive and you can't sell it at the valuation that you thought you would? And interest rates have risen, so your expense ratio is off because your debt obligations are higher. But it also affects and hits hard that 44% of customers. These are people that are moving. As interest rates in the 30-year fixed mortgage have risen, the affordability of houses after COVID has gone down, and we're already seeing a slowdown in the amount of people moving. The important thing to the self-storage bubble is that it is driven more by activity from buyers than it is the underlying asset. Meaning, when you're investing and the asset loses demand due to building or the end consumer not needing it as much, but you are put into a position where you have to execute, meaning you have to sell or refinance, that is dependent on the valuation, that's where the bubble can burst. That's where you run into trouble. All of a sudden, you may be upside down, even though the asset didn't do terribly at all. The key to this is it's avoidable. You don't need to put yourself in a position, and you don't need the bubble to burst and ruin your investing strategy. We also make sure that we are not in areas that are oversupplied. Oversupplied markets are one of the biggest dangers. Once the bubble pops, they have so much vacancy, prices go into a free fall. This is what happened after 2008 and how we purchased a lot of assets that had gone under, bankrupt, or were struggling. Those conditions do not exist today, and self-storage will not survive the same in another credit crunch. We don't know how rising interest rates or coming off the COVID bump will affect the self-storage industry. But it is clear that there will be an effect that already started before COVID ever happened. If you're investing in self-storage, you structure it right, you don't need certain things to take place to make money, you have good cash flow margins, you're operating it off fundamentals with a long-term view, you can sustain the ups and downs of the market. And the structure between investors and financing needs to allow for that resiliency. And you'll be fine in a great asset with great demand. Too many today are underwriting as if everything will continue the way it is. And in self-storage, that's how the bubble bursts. How do you make sure that a market has enough demand so that when the inevitable contraction happens, you'll be fine? Check out this video right now where we really walk through the tools and what you need to invest in a certain market.